Hi, today we're talking about buying debt in a business, and I'm joined today by Luke Shelton from Finance Elite. Now, Luke deals with all manner of businesses, specialising in healthcare, which includes, of course, nurseries. So, Luke, a question I regularly get asked by sellers and buyers is, can you sell your business when there's debt involved?
Yeah, you certainly can do. Obviously, as a buyer's perspective, I suppose, as well, I think the first key bit of information I would say is that, to be honest with you, if you've got a solicitor that's sort of, worth what you're paying them, I think they'd be saying to you, look, debt-wise, I would make sure that that's cleared on completion. And I think that's normally sort of a key part of the legal.
That's very much the case. I mean, in most cases, valuations are done on a no debt, no cash basis.
Yeah.
So when you look at the price point on a business, you are buying it on the assumption that you're not buying debt, but you're not buying the maybe £500,000 they have in cash in the bank as well. But yeah, so it's worked on that basis. But there is an option though.
Yes.
So whereas in most cases the debt will be paid off on completion, and the seller would be expected to do that.
Yeah.
In some cases you can buy debt, can't you?
You certainly can. I think what probably would be the point I would suggest is that if you're a cash buyer, I think it would be a lot more sort of simple process. If you're happy to take on the debt, you could certainly do that. But I think your solicitor would still be there in the background saying, really, we want a clean slate when you take over. From a bank funding perspective, I would say probably realistically on it, they'd probably want you to be debt free when you're taking over.
Well, they don't want you owing other people money even though their money.
This is it. And I think one example I could probably give and sort of float back to that always sticks in my brain from sort of the dental practice side is that we actually had a client that bought a business, dental practice at the time, and they actually took on the hire purchase agreement for a piece of equipment.
Okay.
Now, the equipment didn't actually have a warranty involved.
Oh.
They took over it because it was a new piece of equipment, thinking everything will be fine and dandy. And then what actually happened is the machine broke a few months into takeover. And the actual individual that took over the practice was then stuck with this finance HP agreement that they were having to pay off.
Yeah.
They didn't then obviously, have a working piece of equipment. They had to go out and get another piece of equipment. They were almost paying off. So I think sometimes it's one of those, yes, you'll do your due diligence, but there's only so much you can do.
So types of debt, obviously, for things like HP, it's also checking that
this is it.
It's workable for you, it's serviceable in the long run.
Yeah.
And also, I mean, I think you're very right. For those people who are in a lucky position where they can buy with cash, actually, especially if they would maybe already got some nurseries, they can consolidate debt, they can manage the debt. In the long run, actually, it possibly does work for them and save them a bit of money. But actually, most of the time, we're always working on the basis that even if there is debt on a business, it doesn't mean that debt will be there when you buy it. The seller will be responsible to pay it off, and you're not having to take it on yourself.
Definitely. I'd say that's probably the most common situation we would see, is that on completion, all the debt is cleared, you take over a clean slate of the business, and you can move forward from there with your own arrangements and whatever you want to do. So I think that's something that's quite important for people probably to consider when they move forward.
Brilliant. If you've got any questions, ping them across, give us a call, or drop them in the comments below, and we'll see you again soon.